Stocks continue to rally on, led by IT services and realty, while utilities and FMCG lag. Midcaps outperform.
PVR and Inox Ledger again after the weekend release of Brahmastra surprises at the box office. Despite mixed reviews, the slim release calendar in September, however, remains a worry.
Nazara Technologies gains on Google Play, allowing distribution of fantasy sports via its platform, while Hindustan Aeronautics moves higher on a positive brokerage note.
The head of the IMF, the International Monetary Fund, calls India a bright spot on a dark horizon, even as she warns that 2023 could be worse than 2022 for global economy. Good afternoon. You're watching us here on Halftime Report. I'm Manglam Malu. With me, as always, Sonia Shenoy as well as Ekta Batra. Not looking too bad for the market. 17,960 on the Nifty at the high point. From the word go, it has been extremely strong, and the broader markets actually indicate that strength that we're seeing in our markets itself. We have nearly 2,000 stocks in the green for 900 in the red. And even though the Nifty Bank is underperforming today with a gain of just about 0.5% versus the other players at around 0.75%, we have the IT stocks which are leading the index higher. So a lot of stocks actually buzzing around.
Absolutely, a lot of stocks. And look at PSU banks. I mean, SBI is on a tear right now. It's hit a fresh 52-week high as we speak, and it's up almost about 22% this year. So clearly, banks are also coming back in a big way. There is real estate that's doing very well. Aurobindo Realty at a fresh 52-week high. Lots to talk about in the market, Ekta.
Yes, absolutely. So I think rate sensitives and the gains that we're seeing within rate sensitives seems to be the big theme which is playing out. And I'd obviously watch a lot of the data which is due over the next couple of days. We have the CPI IIP data which is due from India this evening. It is expected to be a sub 7% figure for the CPI for the month of August, which would be the second consecutive month of a sub 7% figure for us. So that would definitely be a positive. And from the US, which is probably the most important cue to watch out for, would be the August inflation data, which is also expected to probably come in at around 7.9 to 8% versus 8% in the previous quarter or previous month. So that's something to watch out for. But nonetheless, let's get talking to a couple of companies then. Medplus is the first stock on our radar. There have been a bunch of brokerages in the past couple of weeks that have initiated coverage on the stock. And for today in particular, it is Nomura which has initiated coverage on this particular counter. We have with us Mr. Reddy, who's the MD and CEO at Medplus Health Services, joining in now to discuss business with us. Mr. Reddy, hi, welcome to the show. You know, before I get to what Nomura is in fact pointing out in their report, I just wanted to do a quick housekeeping check in terms of what margins are like in this quarter for you all. The reason I asked was that the previous quarter margins had disappointed, came in at around 5%. Street was anticipating more. That is because your store additions have been so rapid, plus your diagnostic business took off. Give us a sense in terms of how business is doing this quarter, particularly on the operations.
Well, traditionally, the Q1 of any year has actually been very low for us, has been a weak quarter for us. So that way you could say that Q2 is expected to do slightly better. I can't really give you the numbers, but it is, definitely okay, I would say. On the margins, I'm not sure if we can do a lot better or anything like that, mainly because of two reasons. We are still, building for the future. We continue to, add stores. I don't think that there's going to be any let up on that. Last quarter, we added overall 252 stores. I expect we'll add a similar, if not more, this quarter. So hence, that whatever drag is there on the profits because of new addition of stores is going to be there.
Mr. Reddy, good afternoon and thanks for joining in. I want to understand that this, your revenue growth has slowed down. I mean, you're sitting in low single-digit growth, about 4-5% in the last quarter. It's also because of the base effect, but how much is the threat that you're facing from competition, particularly from e-pharmacies? And what do you see as a sustainable growth on the top line over the next few quarters?
See, we expect to actually grow at the rate of around 20% at least annually. While there is definitely muted this thing because of growth, because of the e-pharmacy guys, I really don't expect it to be a long-term kind of thing. If you look at it, e-pharmacy today is basically going out there and giving a promotional discount of 25% on the first 3 purchases. And there are 3 different guys doing it. So, customers can go between one or the other and keep getting the 25% discount. As long as that is there, we will see a little bit of, dampening of our growth in the big cities at least. But I don't expect it to last, mainly because that is not a number at which any business is actually viable. Sooner or later, they'll come down to 20, and we continue to be the highest, value provider to any customer out there in a normal circumstance, not on a promotional level.
Right.
So while there is a little bit of, that issue going on, I really don't expect it to last. I think we will, just do fine as we move forward.
We take that point. And the other thing that you're doing, to also support your operational performance, brokerages are saying that you are trying to increase your share of revenue coming in from private label. Can you give us a sense of how much it is right now, and where does it go, say, about 2 to 3 years from now? And the diagnostics foray, how has that done for you too?
Sure. So private label, for any retailer, private label is going to be a big part of their profit pool. For us, we started off, focusing on this around 3 years back, at which time we were around 4.5% private label overall. Today, we are at around 12.7% in the last quarter, out of which, 8.4 is just pharma. So we have focused now on increasing the pharma private label, and that we expect will continue to grow. In the next 2 to 3 years, I fully expect that we will end up at least in mid-teens for the pharma private label.
All right.
And on the diagnostic side, that is doing very well. I must say that, we have followed a new model, which is a subscription-based model. We have 2 large centers, and our, both the centers now, are, about to break even at the center level.
Okay, so that's exactly what I wanted to ask. Your subscription-based model, which you rolled out just some time ago in the diagnostic space, it started with a pilot project in Hyderabad. So you're saying that you're going to break even, at least I would assume, on the EBITDA on both of these centers in the diagnostic space. So what exactly is the expansion plan when it comes to diagnostics? Is it probably going to be a little slower simply because of the kind of competition that you're seeing? Every nook and corner, there's a diagnostic lab offering you tests, one cheaper than the other. Is this the feasible space to get into? And would you probably be a little slow in terms of a rollout now?
No, not at all. We don't really see any competition from the likes of, let us say, any of these guys who are just doing the blood tests and all. Because diagnostics is not just doing some blood and urine tests and all. You also have to do the ultrasound, X-ray, ECG, MRI, and everything else and all. We are a fully integrated, platform out there. We are a fully integrated diagnostic center. Our pilot will continue. The pilot, actually has roughly around 4 to 5 large centers in Hyderabad with around 10 to 11 slightly smaller centers, which will have, up to ultrasound. The larger centers will have everything, including MRI and CT. So this is something which we're planning to actually set up such that we have 15 odd integrated radiology centers, 100 to 125 collection centers, and a home collection thing. So this is a complete package. So anyone who wants to actually avail these can actually, call us through the online site or walk into any of our centers or walk into our larger diagnostic centers. We will actually be going into this model, as you know, we're doing it like a subscription model where a customer pays a small amount of money to become a member, and after that gets a large discount, a 75% discount on everything. So looking to see if we can actually embed this into a health insurance kind of play, where customers normally pay roughly around 20,000 rupees for getting annual health insurance. But that insurance does not cover anything as long as if they are not in the hospital for at least 24 hours or more, which basically means any diagnostic thing is not covered. So we're looking to see if for a small addition, maybe 1,000 or 1,500 more, they can now avail themselves of the entire thing, not just the hospitalization, but also the diagnostics. So what that means is we will require coverage across the city, and the pilot then continues, because right now we're basically setting up centers to cover every place in the city.
So I'm sure you've done the numbers then, these 15 radiology centers, over 100 collection centers. Where exactly would it be concentrated geographically? And tell us when you can probably expect to break even, both on the EBITDA as well as the bottom line in your diagnostic foray.
So all our centers are going to be in Hyderabad.
Okay.
The plan is to basically approach everyone in the B2B side, both in the corporate as well as in the health insurance side. So the whole point of, doing it this way is to be able to let, employers buy it for their employees, so that any other employees residing in the city can use the facility across the city. So for us, that's the reason why we're covering it there. It's too early for me to tell you when they'll break even, but all the initial results, are extremely positive. As I said, the first 2 centers, are operationally breaking even at the center level right now. And it's just not even 4 months. We started the whole thing around 4 months back. Today, we have more than 35,000 members subscribed.
Okay. It's just that this entire diagnostic space has become so competitive, right? I'm sure you get asked this question a lot because, I mean, large players like Lupin are now entering the diagnostic space. We know large hospital chains, Aster, DM, whether it's Max Hospital, they've all forayed into this space as well. Now, the Adani group is doing so too. Do you think there'll be a lot of pricing pressure? I mean, I know that it's just been 4 months for you, but are you already facing pricing pressure? And do you think that's something that can keep the margins in low single digits for a while?
We are the price leaders. We are the guys pushing others to put their price down. I don't think we're going to be facing any other price this thing out there. And again, there's a big difference between what we are doing versus, let's say, what someone like a Lupin or any of the other companies which you mentioned are doing out there. They're all primarily focused on just the lab, which is just the biochemistry and pathology and everything else. Even today, the largest chain probably has around 50 to 60 centers. I don't think the largest chain, integrated chain in India, I may be a little, off on the numbers here, but they do not have more than 50 to 60 MRIs and CTs. So it's not really a competitive market. None of these other guys are actually looking to get into this radiology side also. And I am not sure, but yeah, with the one exception of the Adani group, I think they are expected to get into both. But yeah, India is a large market. We can easily take that money, a couple of big players at least.
All right, take that point. Thanks a lot for joining in, and we wish you good luck with your foray into this space and also the strong expansion plans that you have as well. Thanks a lot, Mr. Reddy, for joining in. Wish you good luck.
Thank you.
Welcome back. Let's talk about metal prices now, where we have seen profit taking continuing today as well. It's actually about the concerns coming in from China, where all the economic data has been on the weaker side. The real estate sector is also not out of the woods. That continues to weigh onto the markets as well. The dollar rally has paused a bit, and that perhaps is a bit of a supportive, but everything else really seems to be weighing onto the sector. David Lennox, analyst at Fat Profits, now joins us with his sense on what really could be seen going forward in case of metal prices there. David, hi. How do you look at, first of all, the kind of data that we have seen come in from China and its impact on metals?
Hi, Manisha. Well, look, certainly you'd have to suggest, as you've already said, that the data that we're seeing is showing somewhat of a softer side of growth in China than we've seen over many years. And that's to be expected when you think about the fact that we've got their zero COVID tolerance, which means cities go into shutdown. That obviously stops activity. And we've also got the demise of their property sector. So any growth that was perhaps coming from that sector is now going to be impinging on growth. So one would expect to see over the course of the next probably 3 or 4 months of data read, we'd expect to see China showing continued slowing in growth. On the counter side to that, we're well aware already that the authorities are moving to stimulate certain parts of their economy. So as long as they're trying to do that balancing act, the market should be a little less concerned that we're going to see really drastic or damaging numbers coming out of China. There will be some cushioning because of the change in rhetoric from the authorities, and that's probably just keeping somewhat tension in the metals prices to the upside.
But David, that's a bit just about China. How do you look at the European Union, the power concerns there? That really seems to be leading the metal prices, some support. We've seen so many news of smelters closures there. But on the other side, the power rationing, no electricity availability also has led to fears of recession there. That really is a double whammy there, would you say?
Look, there's no doubt about it. Europe's been really the centre of focus, and it is that very much what's going to happen in terms of their energy as we come into their winter. And if there is a serious disruption or in fact a complete blocking of energy going into that particular region, then yes, there's going to be a considerable downgrade in their growth and probably will lead somewhat to a recession. What we would expect to happen is we would see the central banks actually starting to move more towards perhaps easing and living with inflation that they've got at the moment. But look, that's something that we'd have to wait, watch and see. But at this point in time, yes, Europe's going to, we think, have considerable tough winter, and that could ripple through to the rest of the global economy. China's taking the right steps in stimulating. They need to stimulate certain areas to at least have some form of balancing. We could see Europe going down that same road and then deal with the aftermath later.
All right. So while there is, of course, the factor about China and then Europe, and the third important point clearly is about the interest rate hikes that we've seen global central banks do, and another one coming in from the US Fed on 21st of September. What kind of impact do you see of that on metals?
Well, look, certainly what we've seen happen is as the interest rate differential widens in favour of the US dollars, in fact, rallied quite significantly on the back of that. Plus, as we've just talked about the malaise going on in Europe, we've seen the euro collapse. So one would expect that as those interest rates differentials start to continue to widen in favour of the US, we will see that US dollar stay to the strong side. And as we've seen over many, many occasions, a strong US dollar just does not bode well for commodity prices. And that's really, again, the driving factor that's kept gold in check. It's kept base metals from rallying quite strongly when you throw in the other factors as well. And really, we do need to see that US dollar roll off its highs. The metrics are all there. They've got a slowing GDP. They've got rising debt. So one would expect at some stage investors are going to focus on that. But at the moment, you try and find a currency that's in any better shape than the US, you just can't find them. And that's what's keeping the US dollar to the high side.
Oh, well, I would agree with that. So before I wind down this conversation, a final question really, and this is on numbers purely. So US dollar index, where do you see that headed? And if you had a top trade to take in metals, what would that be?
Manisha, look, we've been calling the US dollar to the downside and we've got it dead wrong. One would have to suggest that somewhere around these levels, we have probably seen the top side in the US, but saying that is quite dangerous. So look, we would think that we would probably see the US dollar starting to slip back, that index heading back towards 100. But at this point in time, it's difficult to see the catalyst for that. And if we had to pick a metal, we'd be certainly looking at lithium and nickel. The long-term prognosis that we see on both of those is very good when it comes to the auto industry. They'll live through the current cycle and they'll live through many cycles, but there's certainly growth to be had in both of those two metals, we think, well down the track.
Okay. Manisha and David, thanks a lot for joining us and giving us a quick update on what's happening in the world of commodities. Welcome back to Halftime Report on CNBC TV18. Now, there are a couple of pharma stocks that are in focus this afternoon. There's Aurobindo Pharma, Ajanta Pharma as well. Ekta, why are you looking at them?
Well, the common theme between them is definitely the US FDA action. So I'll start with Aurobindo Pharma, where we have accessed the Form 483, which was issued to their Unit 11. Remember, the plant was inspected from July 25th to 2nd of August. They were issued 3 observations to the plant. It is a non-antibiotic API facility. Now, why is this important is because it already has issues pending on it. It was classified as an official action indicated status in May of 2019. It was eventually issued a warning letter in 2019 as well, in June 2019. So since then, that warning letter has been unresolved. It was inspected and now issued 3 observations. As per the Form 483, it will be important to see how they react or how they, how they respond to the US FDA. But the reading is that maybe they could be out of the woods when it comes to these 3 observations. And eventually, the hope is that a warning letter could possibly be lifted. Separately, Ajanta Pharma is in focus. That is because the US FDA inspected their Dahej facility, which manufactures formulations, from the 5th to the 9th of September, which is last week. And they have been issued 2 observations. So 2 observations is generally a positive reading that, it's not too much. The company says they are procedural. US sales is around 30% of the export business, and exports is around 30% of the total sales for Ajanta. In Q1, it was up around 6.5%. There was some amount of trepidation in the US guidance because the street is anticipating only 4 to 5% growth in FY23 when it comes to the US.
All right, Ekta, thanks a lot for that. But before we slip into that short break, just keep an eye out on the Itc stock. It's recovered from the lows. In fact, it's been one of the best performing Nifty stocks all this year, up 52%. So what we'll do is take a short break, come back. On the other side will be that big exclusive conversation. ITC's Chairman and Managing Director Sanjeev Puri will be speaking with Shireen Bhan.